Welcome. If you're looking to really get to grips with important info, quickly and thoroughly, you're in the right place. Today, we're diving into something that's, well, making waves. Moody's recent decision to downgrade the credit rating of the United States.
That's right. And we're going to be drawing heavily on some insightful analysis from Chris Lehnes. He's a factoring specialist who laid out his thoughts on this back on May 19th, 2025.
Exactly. This isn't just another headline to skim past, is it?
No, definitely not. A credit rating change for an economy the size of the U.S. that has real weight.
So our mission today is really to look beyond that initial newsflash.
Yeah, to really unpack what the potential consequences are. How does this affect everything from, say, the interest on your mortgage to America's overall standing on the world stage?
Want to equip you with a clear picture of what's truly at stake here.
Without getting lost in, overly technical jargon.
Okay, so Moody's. We hear the name. They're one of the big rating agencies. But what does a downgrade like this actually mean? What's the core function here?
Well, think of Moody's and the others like S&P and Fitch as sort of financial health scorekeepers.
Right.
They assess how likely it is that a borrower could be a company, could be a government. In this case, the U.S. government will pay back its debts.
Right.
So a downgrade is basically Moody's saying, we're a bit less confident than we used to be about the U.S. government's ability to meet all its financial obligations on time and in full.
Which is significant because U.S. debt has always been seen as, well, the safest thing you could possibly invest in, right?
Exactly. The gold standard, almost. So this downgrades kind of chip away at that core assumption. It disrupts that long-held view.
Okay, so it's definitely more than just symbolic. Lehnes, in his analysis, points straight to higher borrowing costs as a key consequence. How does that work? How does lower confidence turn into higher costs?
It comes down to risk and reward. U.S. Treasury yields, the interest rate the government pays on its bonds. They act as a fundamental benchmark for interest rates across the entire economy.
Okay, the baseline.
Precisely. So when an agency like Moody's signals, hey, there's a bit more risk here, investors naturally react. They say, okay, if I'm taking on slightly more risk by lending money to the U.S. government, I need more compensation.
So they demand a higher interest rate, a higher yield.
Exactly. And that increase doesn't just stay with government bonds. It tends to ripple outwards.
How so?
Well, think about corporate loans. Businesses wanting to borrow for expansion or new projects might find their interest rates creeping up because the underlying benchmark, the Treasury yield, has risen.
Okay, that makes sense.
Same goes for mortgages. Higher benchmark rates can translate into higher mortgage rates for home buyers, which could, put a damper on the housing market.
And affects cities and states, too, municipal bonds.
Yes, potentially. Even things like student loans, while maybe indirectly, can feel that upward pressure over time. It's quite pervasive.
And Lehnes argues these higher costs aren't just numbers on a spreadsheet. They start to actively shape economic activity, don't they?
They absolutely do. Think of higher borrowing costs as applying the brakes gently, or maybe not so gently, to the economy.
How?
Well, if a company sees the cost of borrowing jump, they might just postpone that big investment they were planning, put that factory expansion on hold.
Okay.
If mortgage rates climb significantly, fewer people might be able or willing to buy homes. That slows construction, real estate activity.
And for individuals, credit cards, car loans.
Sure, if those rates rise, consumers might become more cautious, pull back on spending. It reduces disposable income, potentially.
So the overall effect is slower growth.
Potentially, yes. It can act as a drag on overall economic activity, dampening GDP growth.
Lehnes also gets into the government's own budget situation. This sounds like it could make a tricky fiscal picture even trickier.
It really could. You have to remember, a pretty significant chunk of the U.S. federal budget already goes towards just paying the interest on the existing national debt.
Right, debt servicing costs.
Exactly. So if the interest rates the government has to pay on new debt or on rolling over old debt go up because of this downgrade, that interest payment slice of the budget gets bigger.
Which leaves less money for everything else.
Precisely. Less money for infrastructure projects, education funding, social safety nets, defense, you name it.
And Lehnes mentions a potential vicious cycle.
Yes, that's a real concern. If rising interest costs make the deficit bigger, that could potentially worry rating agencies even more, maybe leading to further downgrades down the line.
Which pushes rates even higher.
Making the deficit problem worse still. It's a potential negative feedback loop. And, it inevitably puts more pressure on lawmakers to make some really tough calls about government spending or maybe raising taxes.
Now, here's something that sounds huge. the U.S. dollar potentially losing its top spot as the world's main reserve currency. Lehnes suggests this downgrade could be another factor pushing in that direction. Why is that status so important?
Oh, it's incredibly advantageous for the U.S. Having the dollar as the primary currency used in global trade and held in reserve by other countries, well, it creates constant demand for dollars and dollar-denominated assets, like Treasury bonds.
Which helps keep our borrowing costs lower than they might otherwise be.
Yes, that's a major benefit. It also gives the U.S. a significant amount of, let's say, influence in international trade negotiations and even geopolitics. Financial leverage, in a way.
So how does a downgrade chip away at that?
It's about confidence again. The dollar's dominance rests on the perceived stability and reliability of the U.S. economy and its financial system. A credit downgrade, especially if it points to underlying fiscal or political issues, can erode that global confidence.
Does it mean the dollar gets replaced overnight?
Oh, almost certainly not. There isn't really a clear, ready alternative waiting in the wings right now. But events like this can encourage other countries, maybe like China or Russia or blocs of countries, to speed up their efforts to promote alternatives or at least diversify their own reserves away from quite so much reliance on the dollar.
And if the dollar's role does gradually diminish over time, what would be the practical consequences for the U.S.?
Well, less global demand for U.S. assets could mean, you guessed it, further upward pressure on our borrowing costs.
Another feedback loop.
Potentially. And it could also mean a gradual weakening of America's overall economic and perhaps political influence on the global stage. It's not a switch being flipped, but more like a slow, long-term shift in the balance of power.
Lehnes also points out that downgrades like this can make financial markets nervous, leading to more volatility. What's the mechanism there?
Financial markets really value predictability. Stability. A downgrade introduces uncertainty, a new variable that investors have to factor in.
Okay.
Plus, you have large institutional investors, think big pension funds, sovereign wealth funds from other countries, insurance companies. Many of them have rules, investment mandates that dictate they can only hold assets with the very highest credit ratings, like AAA.
So if the U.S. rating drops below that top tier,
They might be forced, or at least strongly incentivized, to reassess their holdings of U.S. Treasury bonds. Some might even have rules requiring them to sell automatically.
and if lots of big players start selling,
That selling pressure can push the price of bonds down and consequently push the yields, the interest rates up. It adds to market volatility.
what about stock markets? How do they typically react?
Generally, not well. A downgrade can be seen as a negative signal about the overall health and future prospects of the U.S. economy. That can dampen investor sentiment, hurt expectations for corporate profits, and lead to sell-offs in the stock market.
Which then impacts people's retirement accounts, household wealth.
Exactly. And that erosion of wealth can further reduce consumer confidence and spending, feeding back into that slower economic growth picture we talked about.
It's interesting. Lehnes also stresses that it's not always just the raw economic numbers that lead to these downgrades.
Yeah.
Politics often plays a big part.
That's a really crucial point from his analysis, and something the rating agencies themselves often explicitly mention. Things like political gridlock, repeated fights over the debt ceiling, inability to agree on long-term budget solutions.
They see that as increasing risk.
Yes, they see political dysfunction as undermining the government's ability to manage its finances effectively and make necessary adjustments. So these political factors can directly contribute to a downgrade.
And that damages credibility beyond just the financial market.
Absolutely. It damages the reputation of the U.S. not just as a borrower, but as a stable, predictable global leader. Allies might start to wonder if the U.S. is reliable.
While adversaries might use it to score points.
Precisely. They might exploit the narrative of American decline or dysfunction, and internally, domestically, it can sometimes deepen political divides and make finding consensus on those needed economic reforms even harder. Politics and economics are really tightly interwoven here.
Given how connected the global economy is, Lehnes emphasizes that the fallout from a U.S. downgrade doesn't just stop at the U.S. border. How does it spill over?
The U.S. economy is just so deeply integrated into the global financial system. Think about how much U.S. debt is held by foreign investors, foreign central banks, foreign governments. It's enormous.
So a downgrade makes them nervous too.
Of course. It creates uncertainty about the value and safety of those holdings. It can also dent global confidence in the stability of U.S. monetary policy, which underpins so much of the world financial system.
What about smaller or developing economies?
They can be particularly vulnerable. Many emerging markets either peg their currencies to the US dollar or rely heavily on dollar stability for their trade and financial models. So volatility or rising interest rates in the US can cause real problems for them.
Like capital flight.
Exactly. Higher U.S. interest rates can suck investment capital out of developing countries as investors seek safer, higher returns in the U.S. That can lead to currency crises in those countries, rising inflation, or even make it harder for them to service their own debts. The ripples can be quite wide and damaging.
So facing all this, what can be done? Lehnes touches on potential responses from the U.S. government or the Federal Reserve. What options are on the table?
Well, there are potential short-term measures. The Fed, for instance, might decide to pause or delay planned interest rate hikes to avoid putting more upward pressure on borrowing costs. In a more extreme scenario, they could even consider restarting something like quantitative easing, buying bonds to push yields down.
Any government actions?
The government itself could look at ways to manage its debt profile, perhaps exploring restructuring options, so that's complex. But these tools aren't magic bullets.
What are the risks?
Well, easing monetary policy further, like with QE, carries the risk of potentially reigniting inflation, which has been its own major challenge.
Right.
And if the government tries to respond with, say, aggressive spending cuts to fix the deficit quickly, that could risk slowing the economy too much, maybe even tipping it into recession. There are difficult trade-offs.
So what's the long-term solution, according to Lehnes?
Ultimately, his analysis seems to suggest that the real need is for addressing the underlying long-term structural issues. Things like finding sustainable approaches to entitlement spending, maybe comprehensive tax reform, putting in place more stable and predictable budget processes, things that tackle the root causes of the fiscal imbalance.
Okay. So if we try to boil down the core message from Lehnes's analysis of this Moody's downgrade, what's the big takeaway?
I think the main point is that this is not just some minor technical adjustment on a rating scale. It's a significant signal. It suggests a perhaps gradual but tangible weakening of America's fundamental economic strength and dominance.
And it kicks off a potential chain reaction.
Exactly. A chain reaction of potentially negative consequence we've talked about. Higher borrowing costs filtering through the economy, increased pressure on government finances, the potential questioning of the dollar's global role, market jitters.
It highlights underlying problems.
Yes. Maybe the biggest danger isn't the downgrade itself, but what it represents. Those deep-seated structural challenges in the U.S. economy and political system. And if those aren't addressed, Lehnes seems to imply, it could contribute to a real reshaping of the global economic order down the road.
Right. So just to recap for everyone listening, we've explored how this Moody's downgrade, looking through the lens of Chris Lehnes's analysis from May 2025, isn't just noise. It could mean higher borrowing costs for almost everyone.
From corporations to home buyers.
More strain on government budgets, potentially chipping away at the dollar's global power.
Creating nervousness and volatility in financial markets.
Damaging the U.S.'s political credibility on the world stage.
And sending potentially destabilizing ripples throughout the entire global economy.
It really connects a lot of dots.
It certainly does. And it leaves us, and you listening, with a pretty significant thought to chew on. How might this kind of reassessment of U.S. creditworthiness, the signal of slightly increased risk, actually influence the long-term balance of global economic power? What signs, what indicators will you be watching for in the coming years to see how these potential shifts might actually play out?